Apps have made investing easy, or at least look easy. Pick a stock, transfer the money, and watch the profits roll on in. Easy, right? Wrong. Most of you watching already know that. It's why you invest with advice, because even if you've been doing it for a long time, investing can be pretty difficult indeed. So in this episode, we outline the 5 most common and most important mistakes to watch out for. Bad news sells, which is why we're surrounded by it. Newspapers want to sell copies, TV and online news stations want clicks and viewing figures. So the more dramatic and doom and gloom a headline is, the more attention it'll get. From an investing point of view, and here comes the bad news, there is always a reason to worry. Unexpected war, global pandemics, election fears, Brexit, trade wars, and that's only the last 12 months or so. This can lead us to focus on the wrong things. To fully understand a market, you need all the information, the bad and the good. This is what cutting out the noise means, filtering out what has already been priced into the market. And I can hear what you're shouting at the screen right now, especially after 2022, but Hannah, this time it's different. Well, stop. This is exactly the kind of thing that can set you up for failure. Financial markets only react to things that are unexpected. So most of the time, your worries are already priced in. Of course, more recently, we've experienced the unprecedented global pandemic or the sudden war in Ukraine. These things certainly weren't on the cards, but they're not a problem with the financial system itself. When the market is taken by surprise, don't just blindly look at the fear-mongering headlines. Be patient. Don't jump to conclusions, and consider if it's impacting the valuation of your investment, that's what you're paying for in the short term, or the value of the investment, its true worth in the longer term. The external forces at work can be many and varied, but what never changes is our reaction. This is always based on fear or greed. Very often, fear is guiding our feelings. Is it the right time to invest? What's the latest news headlines? But here's something to consider. This feeling of fear actually bodes well for the continuation of a bull market. That's a market that still has room to grow, because bull markets end with euphoria and not fear. When considering goals, it's important to look long-term. What do you want from your investments? This is a common investment consideration, and you can hear more about it in episode 1. Are you saving for an early retirement, a comfortable retirement, college funds? Suffice to say that if you're sitting on some cash right now and you're waiting for the right time to invest, the message is clear. There is no good time. First up, don't wait to buy the dip. Everyone always talks about this, especially in times of crisis. Now, you may be well thinking, hang on, isn't this exactly what investing is all about? Reaping the rewards of natural volatility? Newsflash. Time in the market is better than timing the market. It's an oldie but goodie. Research shows that those who stay invested over the long run with a well-diversified portfolio will generally do better than those who try to profit from turning points in the market. For example, imagine that you're sitting on some cash right now, but you want to wait for the bottom. The news agenda's pretty pessimistic, things aren't going well. Then the news agenda gets worse. It can get pretty nerve-wracking. You're scared. But even if the market drops by 5%, you wait. You think because of all the negativity, markets may even dip further. But then markets rebound for no apparent reason, but you still don't buy because there is no reason for this upturn. The news surrounding you is still pretty negative. Then finally the dust settles, the news turns more positive, but guess what? Not only have you missed the bottom, you've also missed a lot of the potential upside. A much more effective strategy than buying low, selling high is to buy high and sell higher. If this is the right stock within the right investment theme, it is not that important if you buy at a high level. And just to hammer home this thought, since 2009, which we now see as the bottom of the market thanks to hindsight, we have consistently been confronted with challenges such as war, disease, the European currency crisis and Brexit. It may not have been a fun market at times as we wait for a bottom or a correction that never came, but the market has overcome each and every one of these hurdles. And over the same period of time, the S&P 500 is up by 500% at the time of recording. The flip side to this is, of course, when markets are good. People often think, oh, well then, it's all priced to perfection. So you still don't buy because you're waiting for a correction. You can't win. So don't try to time the markets. But what if you're already holding a stock that's falling fast? Avoiding a loss is equally important in good investing. Of course it is. It seems pretty obvious. In fact, just keeping a stock for a while longer just to see what happens is one of the worst strategies ever. But how do you spot a loser? It's all to do with fundamentals, the bedrock driving our economies. Take, for example, a company that's done really well in a low or even negative interest rate environment. In this kind of economy, even companies that don't generate positive cash flows can still do well. But then the fundamentals change. When we're in an environment with interest rates of 4 or 5%, these companies can't keep pace. And if you're looking at losses of 70 or even 80%, don't be stubborn. Even if that stock doubles, you're still losing. And if you're holding a stock that really is going nowhere, the best way to recover is to cash out and reinvest into a structural winner. That's an investment that's deep-rooted in long-term investment themes. Always reassess, rebalance your portfolio regularly. The economist Milton Friedman once said that inflation is taxation without legislation. And after what I'm about to tell you, you'll likely agree. Almost everyone holds more cash than they should or think that they might need. A balanced portfolio, that's one that reflects your investment characteristics from episode 1, should have up to 10% in cash. Most people have well over this, and it's easy to see why, because most people run to cash when things get too stressful on markets. They cash out and wait for less volatile times before they return. It sounds like a good safety play, but actually holding cash is really only a good idea for risk-on investors who want to jump on quick opportunities in the market. So safe, it is not. People just think it is because of all the reasons. It's not the right time to invest. I'm waiting for the bottom. Things are too unpredictable right now. But here's the thing. Holding onto cash isn't just about missing opportunities. It can actually be damaging your wealth. If you hold too much of your wealth in cash, you won't be able to keep pace with inflation, meaning your ability to buy things, your purchasing power, will go down, and ultimately it will be more difficult for you to reach your financial goals. And one last thing. Cash sitting in a bank account isn't generating any more cash. Investment dividends and coupons increases your cash pot. So when considering cash, consider this first. Is the reason for holding excess cash transactional because you have short-term needs to access the cash? Is it precautionary because you have a low risk tolerance? Or speculative, waiting for a better moment? If excess cash is held for emergency situations that may arise tomorrow or only in a few years, why are you not considering high liquid cash alternatives? Finally, don't put your eggs all in one basket. This is a simple one. Going all in on one stock or fund really exposes you to risk. Diversifying reduces your risk to negative market volatility and helps you reach your investment goals. Fun fact, financial history shows us an overwhelming majority of your portfolio returns can be attributed to asset allocation. So choosing what proportion of wealth is invested into each asset class is a crucial decision. Typically, a portfolio is split between equities, bonds, and cash, but may also include other asset classes, things like real estate, hedge funds, private equity, and commodities. It all depends on what kind of investor you are. And it's equally important to remember that a portfolio would also suffer from not taking enough risk. Building an efficient portfolio, minimizing the risk for a given expected return, is a very important thing, but so is investing in sufficiently risky assets, because if the time horizon is long enough, then taking risks should pay off. Sometimes the hardest thing to accept isn't falling markets and making losses, but when markets are up and you're not exposed enough to reap the rewards, it's like buying a car and never driving it. Investing is fun, especially when you know some of the common pitfalls that can catch investors out. Here are the main things that we've looked at in this video today. So what investment questions can we solve for you? Comment below. And next time, we'll be looking at how to build the perfect portfolio. So make sure you don't miss that by clicking the like and subscribe button, and we'll see you next time. Bye-bye.